Starting our third topic, sources of funding for startups. Now we'll further discuss the types of funding sources. Personal investment. When starting a business, your first investor should be yourself, either with your own personal savings or with collateral on your assets. This proves to investors and bankers that you have a long-term commitment to your project and that you're ready to take risks. The two issues with this type of fundings are how much personal savings you have and how much personal savings are you willing to risk. Bootstrapping is perfect for anyone who is willing to start his or her own business. Bootstrapping means starting your own business by your own funds and resources without relying on type of external funds. It is a great way to keep complete ownership of your startup and become self-dependent. But bootstrapping has its own cons. You can't scale business with bootstrapping, and if some reason the business goes bankrupt, your hand-earned money will vanish as well. The risk on such type of sources is extremely high. Talking about the second source of finance, angel investors. Angel investors are generally wealthy individuals or retired company executives who invest directly in small firms owned by others. Most of the angel investors are not members of angel groups. Rather, they are business owners, executives, or successful individuals that have the means and the ability to fund deals that are presented to them and which they find interesting. They're often leaders in their own field who do not only contribute their experience and network or the contacts, but also their technical and management expertise. Angels tend to finance the earlier stages of a business with investments in the order of 25,000 to 100,000. Institutional venture capitalists prefer larger investors and investments in the order of $100,000. In exchange for risking this money, they take certain percentage of equity in the business. Equity meaning the ownership. In concrete terms, this often involves a seat on the board of directors and assurance of transparency. Networking is a great way to find an angel investor for business. Now talking about the third source of financing, family and friends. A big source of funding for entrepreneurs is friends and family called seed funding. They can provide funding in the form of debt, loan, you must pay it back at some later date with an interest that you both mutually set, or equity. They get shares in your company or an ownership, or even a hybrid. For example, royalty whereas they get paid back via a percentage of your sales. Secondly, friends and family are a great source of funding since they generally trust you and are easier to convince than strangers. However, there is a risk of losing their money, and you must consider how your relationship with them might suffer in the end. Another risk is that they might not be able to provide the entrepreneur with a large sum of money. Discussing further our funding sources, venture capital funds. A venture capital firm is a limited partnership or limited liability company that invests in startup businesses with potential for a high return on investment for their pool of investors. Most VC firms are actively hunting for startups that want to get funds in return for equity. Venture capital funding is a suitable option for startups that need a larger amount of venture capital for expansion and increasing market share. Venture capitalists and VC firms are professional investors that are more involved with business management, and they play a significant role in setting milestones, targets, and giving advice on how to ensure greater success. Venture capitalists invest in new startups and medium-sized startups they believe are likely to go public or be sold for massive further business profits. Specifically, they want to fund companies they have the ability to be valued at $100 million or more within 5 years. They also go through an expensive and lengthy process of deciding on the best business to invest their venture funds. Hence, the application process and approval usually takes several months. Moving on to our further sources of funding, strategic customers and suppliers. Strategic suppliers or vendors don't normally provide capital for businesses in the form of a cash investment in exchange for equity. However, they do offer credit to their customers in the form of materials, components, and other production oriented goods that go into your product, as well as the goods and services you need to run your business. If you produce, distribute, or retail products, there are three ways of supplies can help you manage cash flow and reduce the need for working capital in the form of cash. Buying on credit, buying on consignment, supply managed inventory. There's another type of funding source, strategic customers. An entrepreneur can sell their products before an official launch in order to raise money. A product pre-sale builds customer confidence and allows the company to evaluate its product demand prior to the official launch. The majority of electronic giants such as Samsung and Apple allows consumers to pre-order and pre-purchase their products before the official release in the market. Crowdfunding and crowdsourcing is another type of fund sources. Crowdfunding sites bring many people together to fund a promising business opportunity. So the startup founder or young entrepreneurs approaches these interactive social platforms seeking funding in exchange for equity, future products at a discounted or just debt. Entrepreneurs can go to crowdfunding platforms to share their challenges or pitch their business ideas to a community of investors or individuals willing to invest in an idea or support a cause. As a result, the platform runs a crowdfunding campaign to derive investors or donors to raise funds to fund the business idea. However, in returns, the pool funds to the crowdfunders if they fail to hit the required demands. It also takes a cut of the raised amount to finance its own operations and sources of potential business opportunities. Since not all crowdfunding campaigns are successful, it's important for startup founders to accompany their pitch with a good story. It should emphasize founders' personal commitment, stress the cash, effort, and time invested in the business. Talking more about crowdfunding. Aside from a PowerPoint presentation, the business owner can add a video appeal to make it more persuasive to crowdfunders. This is due to the heavy competition in crowdfunding platforms. Crowdfunding creates public interest for the business, thus giving it a free marketing in addition to the required capital. The source of funding can also attract venture capital investments in the future. Some examples of well-known crowdfunding platforms include Fundable, Indiegogo, Kickstarter, GoFundMe. Talking further about crowdsourcing. Crowdsourcing is using the knowledge and power of the crowd to speed up a process. The process could be anything from a survey to a website to a certain skill that a company or individual is seeking. Some examples of crowdsourcing: asking a Facebook community for opinions on which bank to use, an example of crowdsourcing. Secondly, finding a logo on the website 99 Designs where users submit options and the client pick their favorite ones. Moving on to a seventh element of funding sources, government and foundations. Governments are looking to support startups' innovation in their communities. Grants are country and region specific, so make sure to correctly assess the possibilities in your ecosystem. They will often be more tailored to specific projects instead of financing an entire business. Additionally, grants often require you to be very detailed on how you will spend the money and will have varying degrees of control mechanism afterwards. Once you have found a specific program to apply for, make sure you fully understand the application process as every grant will have their specific deadlines and requirements. Moving on to our eighth element of the funding sources, pitching competitions. One way to get funding for your startup is through pitching competitions. Pitching competitions are perfect for those who are looking to get feedback about their startups. The best way to enter a pitching competition is to have an epic startup idea and a persuasive pitching deck. Most pitching competitions tend to look for a unique idea. Try to add creativity to your startup idea before pitching it into the competitions. Banks and other financial institutions are a very important element of the funding sources. Bank loans are the most commonly used source of funding for small and medium sized businesses. All banks offer different advantages, whether it's personalized service or customized repayment. Bankers are also looking forward for companies with a sound track record that have excellent credit. Startup loans will also typically require a personal guarantee for the entrepreneurs. This can be your house's document or any other asset that belongs to you. The bank loan isn't a safe option because if for some reason your startup fails, you will be left with nothing, nor your business, nor your assets. It's advisable to shop around for a bank loan because financial institutions offer different interest rates, loan amounts, and repayment periods. Moving on to a final and one of the most practiced funding sources, startup incubators and accelerators. Startup incubators specialize in nurturing businesses, but accelerators focus on fast tracking them. Entrepreneurs access co-working space, mentorship, a network of relevant industry connections, legal services and financial support when they join an incubator or acceleration program. These programs work with new innovative companies with a high chance of disrupting industries. Since the majority of incubators and accelerators are backed by venture capital firms, they look for the future unicorn startup to fund. Therefore, founders spend several months working closely with a team of mentors, and in the end, they get seed money in exchange for a percentage of the company's stake. Joining an incubator or an acceleration program involves completing a highly competitive, lengthy application process. The requirements vary from one program to the other, but the founders must be completely committed during the 4 to 8 months of the program duration.